To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
Students, let's now have a look at the RTP for May 23. First, we'll cover up the questions based on the accounting standard. So, starting with AS5, they don't have anything on AS4, so we'll start with AS5. Net profit or loss for the period, prior period items and changes in accounting policies. State whether the following items are examples of change in accounting policy, change in accounting estimates, extraordinary items, prior period items, ordinary activities. So, you have to classify, right. First one, actual bad debts turning out to be more than provisions. Now, provisions are estimates. So, if the actual bad debt turns out to be more, that is also a part of estimate. So, this first one is accounting estimate. Change from cost model to revaluation model for measurement of carrying amount. So, this is a matter of accounting policy, right, because you have to decide, you are applying specific principles, you are applying specific rules to measure them. This is a part of your accounting policy changes. Government grant receivable as compensation for expenses incurred in previous accounting period. Now, you have received a government grant. Is this a prior period item? There is no error. Okay, this is receivable as compensation for expenses which have been incurred earlier. So, this is not a prior period item. This is more of an extraordinary item. Treating operating lease as finance lease. Now, we don't know whether they have done it in the current period or not. If it is current period, this is an error which you will correct in the current period. But here, looking at the question, prior period item, I think they mean that previously you have treated operating lease as finance lease. So, this is a prior period item. Okay. Capitalization of borrowing cost and working capital, again current period it's an error. If it is a prior period, it's a prior period item. Legislative changes having long term retrospective application, and that is a part of your activities. This can be ordinary or this could be items of exceptional nature. Okay. Changes in method of depreciation from straight line to WDV, this is specifically covered under AS10, which says it's a change in accounting estimate. Government grant becoming refundable, this is extraordinary. Applying 10% depreciation instead of 15% on furniture, this is a prior period item. Change in useful life of fixed asset, this is a change in accounting estimate. Okay. So, if we have a look at this, so first one is change in accounting estimate, change in accounting policy, extraordinary items. So, almost the same things what we have done, right. Then A7 on construction contract. On 1st of December of 21, GR Construction Company Limited undertook a contract to construct a building for 45 lakhs. So, this is the cost of contract price. On 31st March, the company found that it had already spent 32.5 lakhs on the construction. Additional cost of completion is estimated at 15.1. So, 32.5 already spent, 15.1 they will spend. So, 47.6 is what they will spend, 45 lakhs is the expected price. So, there is an expected loss of 2.6 lakhs. 47.6 minus 45, 2.6 lakhs is the loss. What amount should be charged to revenue in the final accounts for the year ended 31st March of 22 as per provision of AS7? So, now here first you have to see what is the percentage completion. How much is the percentage completion? 32.5 divided by 47.6 is the percentage completion. Based on that, you will recognize revenue of that percentage on this 45 lakhs. That is one. 32.5 cost already incurred, and you will also make a provision for loss of 2.6. So, you will make a provision in a way that the loss will be 2.6 lakhs for the period ended 31st of March of year 22. So, here if you see 32.5 divided by 47.6, 68.28% is completed. Revenue to be recognized 30.73, right, 30.73, and 2.6 is the foreseeable loss that has to be recognized. Then PQR Limited, so these are standard questions, okay, these are nothing new, these are standard question. PQR Limited sells agricultural products to dealers. One of the conditions of sale is that interest is at the rate of 2% for delayed payment. Percentage of interest recovery is only 10%. So, out of this 2%, you recover only 10% on such overdue outstanding due to various reasons. During the year, the company wants to recognize the entire interest receivable. See, one very important criteria for recognition of revenue is collectibility. Is there any doubt in collectibility? If there is a doubt in collectibility, then you will defer the recognition part, right? So, AS9, as far as AS9 is concerned, here because the collectability is doubtful, you will account for the interest only when it is received. As per AS9 revenue recognition, where the ability to assess the ultimate collection with reasonable certainty is lacking at the time of raising any claim, then revenue recognition is postponed to the extent of uncertainty involved. In such cases, it may be appropriate to recognize revenue only when it is reasonably certain that the ultimate collection will be made. When there is no uncertainty to ultimate collection, revenue is recognized at the time of sale or rendering of services. Thus, PQR Limited cannot recognize the interest amount unless the company actually receives it. 10% rate of recovery on overdue amount is also an estimate based on previous record and hence is not certain. Hence, the company is advised to recognize interest only on receipt basis as a matter of prudence. But if they want, at the most what they can do is 10% where they have being able to collect, to that extent they may be they may recognize, but generally looking at the overall situation, 10% is only a small amount, hence they can defer or they should defer. The senior accountant of AMF Limited, this on A17, gives the following data regarding its 5 segment, 1, 2, 3, 4, 5 segments, assets, results, revenue. Senior accountant is of the opinion that segment P alone should be reported. Is he justified in his view? Examine in the light of A17. Now there are 3 tests, okay. One is the asset test, second one is the result test, third one is the revenue test. Okay. Now, as far as asset test is concerned, 10% threshold. 10% of 160 is how much? 16. So, anything this. So, 10% of 160 is 16. So, whatever is greater than 16 becomes reportable, which is 80, 30, 20, 20. All these 4 are reportable. Then, on the basis of result, in result what do? Take absolute numbers 190 plus 10, 200, 210, 220 plus 30, 250. So, total is 250. 10% of this is 25. Now, so based on that, this is reportable and this is reportable. Segment revenue 900, calculate 10%, 90. So, anything above 90, this is reportable, that's it. So, based on the asset testing, PQRS is reportable. Based on segment result, T is also reportable. Hence, all segments are reportable segments. On the basis of revenue, P is reportable, that is what you have calculated. On the basis of result, P and T, and on the basis of asset criteria, all segment except T are reportable. Now, coming to the next one, AS18, related party is remuneration paid to board of directors a related party transaction. Normally, board of directors are the one who are, your KMP of the entity, they direct the entity, right? They can, they can have some kind of they can control the entity, and hence these are related parties, and remuneration, any transaction you do with a related party, it has to be disclosed. A very simple and direct question. So, I will not spend much time on that. Then moving on to AS19, very important one. Win Limited has entered into a 3-year lease arrangement with Tanya Sports Club in respect of fitness equipment costing 16,99,999. 17 lakhs should be. The annual lease payments to be made at the end of each year are structured in a way that the sum of present values of the lease payments and that of residual value together equal to the cost of equipments leased out. So, this is what is a finance lease, one of the condition. Unguaranteed residual value of the equipment at the expiry of the lease is estimated to be 1,33,500. The asset would revert to the lessor at the end of the lease given that the implicit rate of interest is 10%. You are required to calculate the amount of annual lease payment and unearned finance income. Discounting factor for 10% is 1 for 1, 2 and 3 is 0.909, 0.826 and 0.751 respectively. Now, they have built the lease in a way that the sum of present values of the lease payment and that of the residual value together equal to the cost of equipment leased out. So, now here what they have said is present value of lease payments plus guaranteed residual value is equal to the cost of the equipment let out, right. Now here the lessor is making 10%. How is it making 10%? See, at the end of 3 years, 1,33,500 is the worth of the asset. At the end of 3 years, 1,33,500 is the worth of the asset. Today, the cost is 16,99,999. So, assume today's cost is 17 lakhs. What is the present value of residual value? Because this is the asset that will go back. What is the present value of that? 133 multiplied by the factor, you will get some amount. The balance amount is what is the present value of lease payments. Balance amount is what is the present value of lease payments. Now, for that present value of lease payments, when you are making equal payments, when you are making equal payments, what you need to know is how we should split this present value into 3 terms. Okay, so to arrive at that, what you can do is you can sum these 3 factors. That will give you present value annuity factor. That divided by this amount will give you the annual lease payments. Okay, so basically, if you make lease payments of 100, for example, 100, 100 and 100, this multiplied by 0.9, this multiplied by 0.826 and this multiplied by 0.751, that gives the present value. Now, we do not know what is this 100, we know x. So, basically what are we saying is, I will just write it down here, 0.909x, 0.826x, 0.751x, all this put together. So, 9 plus 6, 15 plus 1, 16, 6, 1, 2 plus 1, 3 plus 5, 8, 9 plus 8, 17 plus 7, 24. So, 2.486x should be equal to your 17 lakhs minus the present value of unguaranteed residual value. So, whatever amount here you get, if you divide by 2.486, you will get the lease payments, right? That is how you have to approach. So, cost of equipment is so much. Present value of residual value at the end of after 3rd year at 10% is 1 lakh. Fair value to be recovered is 15,99741. That if you divide by 2.486, you get 643,500, right? Then unearned finance income, total lease payment 643,500 into 3. Then add unguaranteed residual value 133,500. That will give you the gross investment in lease. Minus the present value of lease payment will give you the unearned finance income. It's a simple formula driven thing, right? That is the unearned finance income. Now, moving on. Following information is supplied by K Limited. Number of shares outstanding prior to rights issue 2,50,000. So, the moment you issue this, you have to calculate theoretical ex rights price. Rights, 2 new shares for each 5 outstanding shares, 1 lakh new shares. Rights issue price 98. Last date, so 30th June. Fair value immediately before exercising 102, net profits 50 lakhs and 75 lakhs. You are required to calculate basic earning per share as per AS 20 earnings per share. So, basic earnings per share. First TERP. How do you calculate TERP? TERP is equal to number of shares you need for 1 share. So, how much is that? So, now here it is given 2 for 5. So, what you can do is number of shares you need is 5 multiplied by what is the value of that? Fair value before that is 102. So, 5 multiplied by 102 plus you will get 2 shares at 98 divided by total number of shares is now 7. So, 5 into 102 510 plus 98 into 2 196 divided by 7. So, this will be 510 plus 196 706 706 divided by 7. If you do, you get 100.85. This is the theoretical ex right price. Then you need the right adjustment factor. What is the right adjustment factor? Basically the ratio of the fair value and the theoretical ex rights price. Right. So, the value is 102. 102 divided by 100.85 is the right adjustment factor. Now, this gives you the bonus component in rights issue. Right. Now, net profit is given, you are required to calculate basic earnings per share. Now, for basic earnings per share, first you take 2,50,000. How many months is this outstanding? Rights issue was made on 30th, exercise is 30th of June, so 3 months into 3 divided by 12 into 102 divided by 100.85, right? That is one part. Then, after the issue, you get how many shares? For every 5 you get 2 shares. So, 250 by 5 is 50,000 into 2 is 1 lakh. 1 lakh into 9 divided by 12 will give you the, will give you the number of shares. Then you take the profit and divide by number of shares, you will get the weighted average, you will get the basic earnings per share. Previous period 75 lakhs divided by 2,50,000. So, the EPS is 30. That 30 you have to restate. Basically, what you have to do is 30 divided by the right adjustment factor will give you the restated EPS. So, let us see. So, let us see. 100.86 we already calculated, rounded off, we took 108.5. Then we got the adjustment factor. Then EPS 2021 originally reported. Oh, sorry. So, I read 2021 and 21-22 ulta. First is 2021 which is given. So, reported 20 and restated. What do you do? Restated is 50 lakhs divided, restated what do you do? 20 divided by 1.01. So, you can directly say 20 divided by 1.01. Then, for the year current period, you take 2,50,000 into the adjustment factor into 3 by 12 and 350. So, I think here also I just took 1 lakh, you have to do 250 plus 1 lakh which will give you 350 into 9 by 12. Okay. And then with that you can calculate. The next one on AS24 discontinuing operations. A consumer goods producer has changed the product line as follows. Dishwashing bar, clothes washing bar, January 21 to September 21, 2 lakhs, 2 lakhs, October to December 1 lakh, 3 lakh, January nil 4 lakhs. The company has enforced a gradual enforcement of change in product line on the basis of an overall plan. The board of directors has passed a resolution in March 21 to this effect. The company follows calendar year as its accounting year. You are required to advise the company whether it should be treated as discontinuing operation or not. Now, in this kind of question, first you have to define what is a discontinuing operation. Okay. Then, when should we treat the operation as a discontinued operation? So, a discontinuing operation is a component of an enterprise that the enterprise pursuant to a single plan is disposing of substantially in its entirety, or disposing piecemeal, or terminating through major abandonment. So, through a single plan is doing one of these three things which represents a major line of business and that can be distinguished operationally and for financial reporting purpose. Then, in the given case, the company has enforced a gradual enforcement of change in product line and does not represent a separate major line of business and hence is not a discontinued operation. Now, here it is a matter of your judgment. See, this is also washing bar, this is also washing bar and does not represent a separate major line of business and hence it is not a discontinuing operation. If you assume that it is a separate major line of business, then in that case the initial disclosure event is either the enterprise has entered into a binding sale agreement for substantially all of the asset attributable to the discontinuing operation, or the BOD or similar governing body has both approved a plan for discontinuance and made an announcement of the plan. In that case, you will report it as a discontinuing operation. So, just because when you are trying to phase out a particular product and introducing a new product, it may not be considered as a discontinuing operation because you are switching product lines, the operation is not being shut. Then AS26, as per provisions of AS26, how would you deal with the following situations? 23 lakhs paid by manufacturing company to the legal advisor for defending the patent of a product is treated as a capital expenditure. Now, you already have a patent and if you are now paying something for defending the patent, that will not add value to the intangible asset. But if you are paying legal fees to create a patent, then that becomes your intangible asset. So, in the first case, legal expenses to defend the patent of the product should not be capitalized because you are defending the patent, you are not adding value to the patent. So, one thing very important here is that it should be probable that the expenditure, the subsequent expenditure will enable the asset to generate future economic benefits in excess of its originally assessed standard of performance and the expenditure can be measured and attributed to the asset reliably. So, here by defending the patent, are you getting something more? You are not getting, and hence this cannot be capitalized. Then second one, during the year 21-22, the company spent 7 lakh for publicity and research expenses on one of its new customer product line which was marketed in the same accounting year but proved to be a failure. Research expenses should always be expensed. So, this also will be expensed. A company spent 25 lakhs in the past 3 years to develop a product. These expenses were charged to P&L since they did not meet the AS26 criteria. In the current year, approval of the concerned authority has been received. The company wishes to capitalize this as a prior period item. Now, we know there are some conditions which should be met for recognizing development expenditure as intangible asset. Now in the past you have expensed, now you want to bring that back, reverse it. Is it possible? It is not possible. So this is also not allowed. A company with turnover of 200 crores and an annual advertising budget of 50 lakhs has taken up marketing up of a new product. It was estimated that the company would make a turnover of 20 crore from the new product. The company has debited the P&L the total expenditure of 50 lakhs incurred on expensive special initial advertisement campaign. Now this is perfectly valid because advertisement expenses does not create an intangible asset. You cannot identify separately the asset which is created because of advertisement. See, when we do advertisements, it can result in goodwill, it can result in brand value. You cannot say that advertisement has created a separately identifiable intangible asset. So this treatment to charge everything to the P&L is absolutely fine. So the company cannot capitalize 25 lakhs. Research expense, you have to expense it off to P&L. Then moving on ACE 29, A Limited provides for after sales warranty for 2 years to its customer. Based on past experience, the company has the following policy for making provisions for warranties on the invoice amount on the remaining balance warranty period. Less than 1 year 2%, more than 1 year 3% provision. The company has raised invoices as under 11 February, 25th and 4th October. Calculate the provision to be made as on 31st of March and 31st of March 22 and also compute the amount to be debited to P&L on account for the year ended 31st March of 22. Now this is a standard question which is picked up from the material itself. We have discussed these questions in the past as well. So nothing specific. What you need on 31st of March of 2021. Okay, means for this, so how many years warranty do they give? They give 2 years warranty. Now if you look at this on 31st of March of 21, something which expires on 11th of Feb, it is less than 1 year. So if it is less than 1 year, you will take how much? 2%. Something which expires on 25th of December, greater than 1 year, you will take 3%. Something which will expire on 4th of October, this date is after 31st of March, so not relevant. So 60,000 into 2 and 40,000 into 3, 1200, 2,400. So here it should be 2,400. Come to 31st of March of 22. This one is already gone, so not relevant. 25th of December, less than 1 year, right? So 2%. 4th of October, more than 1 year, 3%. 2% of what? 2% of 40,000 is 800. And 135 into 3%, 13 3s are 39, 5 3s are 15, 4,050. So 4850 is the provision, and from 2400 to 4850, 2450 should be the expense for the next period. So let us see 4850, 240 and 4450, right. So that concludes the aspect related to accounting standards for advanced accounting RTP May 23.